Good afternoon, everyone. This is Jordan Arguez, Director at MBAF. Thank you all for taking the time out of your day to join us on our webinar for the CARES Act and how it impacts your business. I'm going to introduce our panelists, our presenters today. Gretel Anasagasti, she's a principal in our Tax and Accounting Department. David Moshevelli, principal in our Audit Department, and Christina Ashby, VP Wholesale Risk Officer from City National Bank. One thing I do want to note to everybody participating in the webinar is this presentation will be available for download in the handout section if you look at your control panel on the GoToWebinar. We'll also be sending out a follow-up email, which will include the presentation and the on-demand recording of the webinar this week. We'll be offering one CPE credit during this webinar, and if this applies to you, just please make sure that you answer the 3 polling sections or questions that are going to take place at the end of each presenter's sections. And the certificate for the CPE will be mailed to you within 1 week of completion of those questions. If you have any questions, please feel free to type them into the questions section on the control panel. We'll do our best to address all of them if the time permits. And if not, what we'll try to do is aggregate, technical questions and get back to people or publish some sort of a frequently asked questions on MBAF's website. So with that being said, I am going to cover the agenda real quick. We're going to go through payroll credits, the delay of payroll taxes, modification of excess business loan losses and net operating loss carrybacks, qualified improvement property corrections, and the hot topic of the Paycheck Protection Program. We'll give an overview of the program, and Christina from City National will touch on this program and the application process from the bank's perspective. So Gretel, if you want to go ahead and get started on the taxes.
Yes, sure. Thank you, Jordan, and good afternoon to everyone. Now, as you are all aware, the CARES Act passed into law last Friday brings with it a number of provisions that will benefit not just individuals, but also small to mid-sized businesses as well. This act, as you all know by now, is one of the most expensive pieces of legislation passed. And I'm confident that most, if not all, of our clients will really benefit from these changes. So today we want to talk to you just a little bit about what these changes are and how they can impact your business. So one of the areas that could benefit a great deal of taxpayers are the payroll taxes offered, okay? Now, although today's presentation is really going to focus strictly on the CARES Act, I did want to mention quickly and talk about the Family First Act. And I don't even have a slide on this because, again, it doesn't pertain to the main subject of today's presentation. But it's important to understand that the Family First Act, which passed a few weeks ago, March 18th to be exact, even though it feels like months and months ago already, it required certain employers to provide the paid sick and family leave, okay, for its employees. However, employers that are required to have this paid leave will receive a credit for the amount that they pay their employees. And the credit is subject to certain limitations, which will be, beyond the scope of this presentation. But this paid leave requirement applies to businesses with less than 500 employees. So it does apply to a lot of our clients. A lot of taxpayers are going to be covered into this. Now, businesses that have less than 50 employees could potentially be exempted from this requirement to provide paid leave if they can prove that the payments would cause the business undue hardship. However, we're still waiting on guidance from the Department of Labor to really clarify how this exemption or how this waiver would work. So that's the Family First Act. Now, another significant payroll credit, which did come under the CARES Act legislation, is the Employee Retention Credit. And if we can go to the next slide. I think I may be on delay. I'm not sure if everybody's seeing the next slide. Yep, there it is. Okay, so employers that operated in 2020 and have been forced to fully or partially close their businesses due to a government-mandated shutdown, for example, non-essential retail stores, as well as entities whose businesses have suffered a reduction of 50% or more of receipts as compared to the same calendar quarter in the prior year. These businesses are entitled to this credit as long as they are still paying employees during this time. So the IRS recently issued an FAQ which clarifies what this partially suspended means, and one example is restaurants who have been ordered to close to diners, but they can still continue to sell takeout or delivery. They would be eligible for this credit, okay? Now, the employee retention credit is a fully refundable credit that applies to 50% of qualified wages paid after March 12, 2020, and before January 1st, 2021. And the maximum credit is a total of $5,000 per employee, which is basically 50% of the maximum eligible wages of $10,000, okay? For purposes of this credit, the definition of qualified wages depends on the size of your business, okay? Employers with more than 100 full-time employees may only take this credit if they are paying employees who are not working as a result of either the economic hardship or because of the mandated shutdown, as I just mentioned. However, employers with less than 100 employees are entitled to the credit for wages paid to their employees, even if their employees are continuing to work during the shutdown. For example, many or most of us who are now working remotely from home, okay? Now, this credit will not apply to businesses that are already claiming the family or sick leave credit for the Family First Act or other types of work opportunity credit. So you can only take one credit, which makes sense. In addition, the employee retention credit is not available if the businesses also apply for the Payroll Protection Program loan, which is very important, and this is going to be discussed later in the presentation. It's also important to note that for purposes of the 100 employer test, affiliation rules will apply, so related employers must be aggregated to figure out whether or not you can get a credit even if your employees are still telecommuting or teleworking. Another important caveat is that the credit is not allowed for wages paid to direct or indirect owners who own more than 50% of their business and their relatives. So if you have a business that's owned 100% by the father, wages paid to the daughter will not be eligible for the credit. So that's important for many of our small businesses. Finally, any wage that receives the credit will not be allowed as a deduction on the business tax return. Okay. Now, in addition to the work opportunity credit and the employee retention credit, once a business determines the actual payroll tax owed for the remainder of the year, the CARES Act allows you to defer the employer's 6.2% share of Social Security tax. 50% of the total amount deferred will be due on December 31st, 2021, and the remaining 50% will be due on December 31st, 2022. Now, this is clearly a fantastic way of keeping the cash in the employer's pocket. Although it's important to remember that it's only a deferral, it must eventually be paid. So save it, don't spend it, okay? Now, the deferral of the payroll taxes kicks in as of March 27, 2020, which is the date that the act was enacted last Friday. So for all payroll return taxes going forward, from now all the way through until December 31st of this year, the employer portion of the payroll taxes will not be due with a return. A very important aspect of this deferral, though, is the interplay with the SBA payroll protection loans, which, as I've mentioned earlier, David will be discussing with you shortly. But essentially, businesses that will have a portion of the payroll protection loan forgiven will not be able to defer payroll taxes. Now, the timing of how this happens and when this happens is a subject that probably needs a little bit more clarity, but again, David will speak to you, and we will all speak to you a little bit more on this later. Considering this, though, it seems if you have to pick between a loan forgiveness and a deferral, the loan forgiveness will usually be the way to go. But the truth is that the payroll deferral program is available for all employers, whereas the forgiveness on the loans is not. So if you have a business that has more than 500 employees, it'll still be eligible for the deferral program. So that's going to be a really nice benefit for many of the larger businesses. Okay, so on to the next section, which would be really the modification of losses and NOLs available. So in addition to all the various credits that we've discussed, the CARES Act also really made a lot of important changes to different types of tax areas. And one of these is this modification for losses for individuals. The 2017 Tax Cuts and Jobs Act added a section for excess business losses, in which losses from businesses were limited to $500,000 for married individuals and $250,000 for single taxpayers. Any business loss that they had in excess of this amount was suspended for future periods. The CARES Act has eliminated this restriction retroactive to 2018 and going forward all the way to 2020. This means that individuals that were impacted by this limitation can go back and amend their 2018 or their 2019 returns if those have already been filed, which not that many have been, but they can go back, amend, and release these losses. So in addition to having these losses released, if these losses ended up triggering or causing a net operating loss or an NOL, the individual can also now carry back these NOLs for 5 years, which is a great segue into the next subject that I'll talk about. But essentially, if you have a loss that was suspended in 2018, not only can you go back, amend your return, and release these losses to offset other sources of income that year, but if you end up still having an NOL, you can carry it back all the way to 2013. So the impact of these two changes honestly will provide many clients with much needed access to cash. So the second part of the act that deals with these losses is, as I said, the modification to the NOL carryback period. Now, the Tax Cuts and Jobs Act that I've spoken about a few times already and probably will speak about it again, it eliminated the ability to carry back losses for years starting in 2018 and afterwards. So in addition to eliminating that ability to carry back, it also limited the carry forward of NOLs so that they can only be used to offset 80% of taxable income when carried forward until 2021. Once again, this negatively impacted many taxpayers, okay? The CARES Act has suspended this rule. And not only, as I mentioned earlier, not only does it let you go back and carry back losses from 2018 for 5 years, which it used to be the case that you could only carry back 2 years now. Not only did they bring it back, but they expanded it to 5 years. But now you can also, anything that you can't carry back, you can carry forward and use it to offset 100% of your taxable income going forward from now through 2021. And another important thing is that this NOL modification applies not only to corporations, but to individuals as well. Now, because the tax rates have been reduced in the past 2 years, the ability to carry back an NOL to periods going all the way back to 2013, really, not only does it provide the benefit of the acceleration of the losses, but it's entirely possible or even probable, really, that the loss is going to be carried back into a period in which the individuals had a higher tax rate, which translates to higher refunds than what would have resulted if you just carried forward the losses in the future. So again, this is, a phenomenal benefit, and I think it's going to be significant for many, many individuals. Okay, so going on to the next presentation, or the next section here of my presentation. So Jordan, can we go forward? I think I probably started talking about the modification of the NOLs before it was up on the slide. So if that's the case, I apologize. But now that we've talked about the excess business losses and the modification for the NOLs, I'm really ready to talk about my favorite part of this presentation, which is the qualified improvement property. So I'll give a second so that we get to that slide. One more There you go. Qualified Improvement Property Correction. Now, as I said, this is a part of a presentation that I've been looking forward to give for the past 2 years. Anyone that has worked with me, or even knows me for that matter, knows that the qualified improvement error has been my biggest pet peeve. And I was so relieved that they finally included they included the correction in the CARES Act, even though, to be completely honest, it has absolutely nothing to do with the coronavirus, but we'll take it. So just as a little background, the Tax Cuts and Jobs Act of 2017 intended to make improvements made to the interior portion of non-residential businesses a 15-year property life, and thereby making it eligible for 100% write-off under the bonus depreciation rule. However, a technical error in drafting of the 2017 Act excluded this type of property from the shorter recovery life, and instead grouped it with 39-year property, which is not eligible for bonus depreciation. So this significantly impacted many taxpayers across all industries. The CARES Act finally corrects this error by making the expenditures for qualified improvements property made by the taxpayer. So that's a new change in the language. It has to be made by the taxpayer, but any improvements to the interior portions of non-residential real property will be eligible for 15-year life and bonus depreciation. And more important than the correction is they made it retroactive to 2018, which means taxpayers can amend their 2018 and 2019 tax returns to reflect this accelerated depreciation available. Alternatively, if a taxpayer doesn't necessarily want to go through the administrative burdens of amending tax returns, particularly for flow-through entities with numerous owners, there also appears to be an option where you can instead file what's known as an automatic change in accounting method. This change in accounting method would be filed with a current period tax return using a Form 3115. And an adjustment will be calculated to catch up, quote unquote, the depreciation for eligible property as if the property had been depreciated under the revised language since or going back to the date that it was originally placed in service. Okay, so it's important to note though that for partnerships that fall under the new Bipartisan Budget Act, known as the BBA, if the partnership did not elect out of the new centralized audit regime, an amended return would result in what's known as an administrative audit request. And again, the mechanics of this are beyond the scope of this presentation, but basically the administrative audit request, or AAR, would create an adjustment in the year of the amended return, but that adjustment would then be allocated to the members or partners to take into account in their individual tax returns for 2020. So it's a little complicated, but it's an important thing that I just want to throw out there. So goes without saying that the decision of whether or not to amend or to file a change in accounting method is obviously a complicated one, and it really needs to be very carefully analyzed depending on each taxpayer's individual circumstances. So that's my spiel on the qualified improvement correction. And as you can see, these are just a few of the many changes and benefits that the CARES Act has provided. And the truth is they can be pretty substantial in many cases and provide much, much needed help these days. So
thank you, Gretel.
Yeah. Nope,
glad you got your qualified improvement property fix, and there's obviously a lot of great tax relief there for businesses and individuals. Before we move on to the next section, we're going to do our first polling question in order, for everybody to receive their CPE credit. So if you look into the control panel of the GoTo webinar, you'll see that there's a poll open, and it'll give you about 20 or 30 seconds or so to answer the question. And the question is, if your business chooses to delay the 6.2% employer portion of the Social Security payroll tax in 2020, that 50% of your deferred liability would be due December 31, 2020, and the other 50% by December 31, 2022. And we'll go ahead and close out the poll there. And then the correct answer there is false. I mean, the first 50% is not due until December 31 of 2021, not 2020. The second portion is correct. All right, so to move on to the next section of the presentation, the webinar, the Payroll Protection Program, which I know a lot of people are very interested in. We've had a lot of clients reaching out and obviously a lot of things happening over the past couple of days. So I'm going to let David Moshevelli from our New York office talk and give an overview of the program. And as we mentioned before, Christina Ashby will talk from the bank's perspective. She works with City National Bank and what the lenders are going to be looking for and how to apply, et cetera. So David.
Thank you, Jordan. Thank you, Gretel, for an excellent presentation. And thank you, everyone, for joining us today. I will again discuss the topic that I'm sure most of you are very interested in, and that is the topic of the Paycheck Protection Loans, as Jordan mentioned. And as many of you know by now, the CARES Act was signed into law just several days ago in an effort to keep certain eligible small and medium-sized businesses, sole proprietorships, independent contractors, and as well as nonprofit organizations afloat during the coronavirus outbreak by providing access to almost $350 billion in forgivable loans. So these loans are referred to as the Paycheck Protection Loans, and I will refer to them interchangeably during this presentation as either PPLs or PPP loans, throughout the slides. So these loans can be obtained through June 30th, 2020, and are fully guaranteed by the federal government. However, as part of the borrowing process, the borrowers will be required to provide certain good faith certifications to obtain the loans. These include the fact that the loan request is necessary to support ongoing operations due to the uncertainty of current economic conditions, the fact that the borrower will use the loan proceeds to retain workers and maintain payroll and or make mortgage interest, lease, and utility payments. The borrower does not have, and also the fact that the borrower does not have an application pending for a loan for a duplicate purpose as the PPL. And finally, in order to qualify for forgiveness, the proceeds from these loans may only be used for certain designated expenses, which we will again cover in a few minutes. In addition, Christina from City National, as Jordan mentioned, will discuss the loan application process, the documentation that will be required to apply, and other loan terms. So that brings us to the next slide, and who is actually eligible for a PPE loan. And so as I already mentioned, any business, sole proprietor, independent contractor, self-employed individual, as well as nonprofits that were in operation on February 15th, 2020, had payroll, and had 500 or fewer employees can apply. And the term employees covers full-time, part-time, and any other basis. So essentially almost all type of employees are included. In addition, entities with more than 500 employees could still be eligible to apply so long as they qualify as a small business pursuant to the Sba size standards. I'd like to go back for a second to the 500 employees threshold and point out that for entities in the accommodation and food service sectors, which have been especially hard hit by the outbreak, the threshold will be applied on a per physical location basis, as opposed to entity-wide. So essentially what this is saying is that if you're in the hotel and food space, you are not limited to a 500 employee threshold like the other sectors are. In addition, as a key takeaway, I'd like to point out that it's important to consider Sba's affiliation rules when applying these loans, and we'll go through those later on in the presentation. So what is the maximum loan amount that a borrower can apply for and be eligible for? and I'm sure this is a question that a lot of you have been asking. So the maximum loan amount that an entity can obtain is actually the sum, is the lesser of the sum of average monthly payroll costs, which we will discuss in a minute, for a calendar year 2019. And there is an exception if you are a seasonal employer, multiplied by 2.5. Added to that, any disaster relief loans that you may have taken out after January 1st, 2020, such as, for example, an economic injury disaster loan, or 10 million. So essentially, it's the average monthly payroll cost for the calendar year 2019 times 2.5 plus any EIDL loans. Compare that to 10 million and the lesser of the two. Just to point out, we will go through an example in a few slides to reinforce this concept. And again, with respect to loan terms, Christina will provide additional details. So now that brings us to the next slide, and what is included in payroll costs. This is actually a term that was that's defined in the guidance and pursuant to the latest guidance from the Treasury, which was released yesterday. Payroll costs are defined as the sum of the following items, which are gross salary, wages, as well as employee benefits, which are listed on the slide, including vacation, parental leave, family and medical, etc., as well as state and local taxes assessed on the compensation. For sole proprietors and independent contractors, payroll costs include wages, commissions, income, or net earnings from self-employment capped at $100,000 on an annualized basis. So the key takeaway, one of the items that was clarified in the latest guidance from the Treasury, which was a slight deviation from the language that was contained in the original Act, is that payroll costs in total are now capped at $100,000 per employee on an annualized basis, as opposed to the language in the Act, as it originally drafted, suggested that only the wages and salary portion of payroll costs would be capped. So to some extent, this distinction makes the program a little less generous to some extent. In addition, the latest guidance seems to indicate that payments made to independent contractors should not be considered in payroll costs, which is also a deviation from the literal text or the language that was contained in the Act. So if you go to the next slide, I just want to point out here in terms of the costs that are not included in payroll costs, and those are again excess of total payroll costs above the $100,000, payroll taxes, compensation to any employee that is not based in the U.S., as well as for any qualified sick leave or family medical leave that Gretel discussed in the beginning of the presentation. So that now brings us to an example, and the example I have here is ABC Dry Cleaning Company applies for a Paycheck Protection Loan, let's say today, April 1st, 2020. The company had $1.2 million of total payroll costs, as we defined earlier, for the calendar year 2019, which gives them a monthly average of $100,000, which is essentially $1.2 million divided by 12. So in this scenario, ABC Dry Cleaning would qualify for a Ppe loan in the amount of $250,000, which is $100,000 multiplied by 2.5. And obviously, you take the lesser of the two, the 250 or the 10 million. So on the next slide, I just want to touch upon the Sba Affiliation Standards, which I mentioned in my previous slide. It's very important to consider and evaluate Sba's affiliation rules for eligibility purposes, i.e. the 500 or fewer employee rule. Since we don't have time to dive into this, I will provide some general context. So essentially, borrowers could be subject to affiliation rules when one entity controls or has the power to control another entity, or when a third party or parties control or have the power to control both entities. So in these cases, you would have to combine the employee counts across the entities in order to determine whether you meet the 500 employee threshold rule that we discussed. So as you can imagine, these rules could potentially make some entities ineligible to apply for the PPP loans. So as an example, this could potentially apply to partnerships that are controlled by the same individuals, which may have to aggregate its employee count. So as I have also listed here, there are a number of other general affiliation concepts, just to name a few, and a full set of these are available on SBA's website, and we've provided a link to the page in the slides. Now, one thing that I did want to point out here is that the CARES Act and the latest guidance have specifically waived these affiliation rules for, as I mentioned earlier, the accommodation and food and service sectors, food service sectors, which are covered under the NAICS Code 72, as well as for franchises and entities that receive financial support or are owned by small business investment companies, i.e. SBICs.
So, David, if I just add one thing real quick to that, to highlight, you mentioned the franchises, and I know we have several auto dealership clients, so that is something that is applicable to them, and the OEMs right now, the auto manufacturers have already all started the process of applying for these franchise codes in order to be able to be eligible, and excluded per these affiliation waivers that they're doing.
Right, that's a great point, and yes, that's certainly one aspect of the rules that you would take advantage of if you're a franchise. Now, moving on, as I mentioned, these loans are forgivable. So the next question is, what portion of these loans will actually be forgiven? Again, the CARES Act allows for the entire amount or a portion of the PPL to be forgiven on a tax-free basis to the borrower. So this is a key point. Normally, loan forgivenesses are taxable to the entity receiving the forgiveness. In this case, they have made this forgiveness to be non-taxable or tax-free to the borrower. And the forgiveness amount, which is subject to a number of conditions, which we will discuss in a minute, will be based on the amount of loan proceeds spent on the following type of expenses during the 8 weeks following the receipt of loan proceeds. So this is very important. So let's say you apply for a loan today and you receive the proceeds on, say, May 1st of 2020, you will have 8 weeks from that point on, from May 1st, to spend. So essentially, expenses, payments made for the following 4 expense categories over the next 8 weeks will qualify for forgiveness. And those include payroll costs, which we have gone over previously, mortgage interest on mortgages incurred prior to February 15th, 2020, as well as rent under lease agreements enforced before February 15th, 2020, and utility payments that include things like electricity, gas, water, transportation, potentially, as well as telephone and internet access. Now, it is important to keep in mind here that these expenses must have actually been paid during the 8-week period to qualify for forgiveness. So you must have actually physically paid for the expense. So if we go on to the next slide, there are a number of conditions, as I mentioned, that are tied to having these loans be forgiven. And there are essentially 2 concepts here. One is that, again, as I already mentioned, the proceeds must be spent on certain expenses. And the second requirement is that the borrower maintain the employee count as well as compensation levels. So the amount of the loan will be reduced if the borrower reduces its workforce during the 8 weeks after receiving the loan, or reduces the compensation of employees earning less than $100,000 of annualized salaries by more than 25%. So what this essentially does is, if you reduce your headcount after obtaining the loan, or reduce compensation levels of anyone making less than $100,000, your loan won't be forgiven. I do want to point out, though, that borrowers can avoid the reduction in the forgiveness if they restore their full-time employment levels and salary levels. So if you let people go or reduce their comp, however, if you rehire them or if you adjust their comp back to what it was prior to June 30th, you would avoid the reduction. And this applies to any changes to employment levels or compensation levels made between the period of February 15th, 2020 through April 26th, 2020. Okay. So now the next slide shows the actual formula for computing the forgiveness or the reduction in the forgiveness amount. And as I said, it's based upon essentially taking your average employment levels, the average number of full-time equivalent employees during the 8 weeks after loan origination, and dividing that number by the amount of employees you had during the period of February 15th, 2019 through June 30th, 2019, or during the period of January 1st, 2020 through February 29th, 2020, and multiplying the payroll costs and interest and so on, all of the qualified expenses by that amount, by that quotient. And so again, to seek forgiveness, a borrower must submit to the lender an application that includes documentation verifying that that the number of employees, pay rates, and so on have maintained throughout the covered period. And as I already mentioned, the reduction can be avoided if you restore your employment and compensation levels by the end of June. So that brings us now to some of the questions that we have received over the last several days from our clients. And so I'll just go through them and anyone can chime in if you guys have anything to add. So one of such questions that we've gotten is, I'm an independent contractor or a gig economy worker. Am I eligible to apply for the PPL? And the answer is yes. As I mentioned in my slides, sole proprietors, independent contractors, gig economy workers, and self-employed individuals are all eligible for the Paycheck Protection Program, subject to the $100,000 limitation that I discussed. And the second item is a question that Gretel alluded to in her section of the presentation, having to do with deferring the Social Security portion of the payroll tax, and can I still defer the Social Security portion of the employee portion of this tax and have the PPL forgiven? So the answer is yes. However, there's one thing to be aware of, in that any previously deferred Social Security tax payments will become due once the PPL or a portion thereof is forgiven. And there may be some additional guidance coming out in this from the IRS that we may see in the near future. If you go to the next slide, we have a couple of more questions that we have seen that I think would be beneficial. And so the next one is, are guaranteed payments to partners included in payroll costs? And Gretel, perhaps you can take this, because I think this is something that's come up with some of the clients that you have seen.
Sure. Thank you, David. Yeah, actually, I mean, everyone that works with me knows I deal a lot in partnership tax, and this question has come up many times already over the course of the last few days. The answer is, as far as we can see, it's not clearly spelled out in the Act, right? Whether or not guaranteed payments are included as payroll costs. But based on the interpretations and based on the analysis of everything else, we are fairly confident that they would not be included in the payroll tax of the partnership that's paying the guaranteed payments, okay? However, the partners that are receiving this guaranteed payment income would be able to include those payments capped at $100,000 as part of their income from self-employment. So even though the partnership can't really, or we believe they can't use these guaranteed payments as part of their payroll costs, the individual partners, if they apply and they're not subject to affiliation rules, et cetera, the individual partners may be able to apply for individual loans and take advantage of the forgiveness on that portion.
Okay, great, thank you. And I thought it would be beneficial to provide an example related to how much of the loan could actually be forgiven. I know we gave the formula earlier in the slides, but I thought it would be helpful to provide an actual example. And I wanted to sort of continue with the previous example with ABC Dry Cleaning. So let's assume that they obtained the $250,000 loan, and let's say that in the first 8 weeks after receiving the loan, they had $200,000 of expenses related to expenses that were paid of payroll costs, rent, and utility payments. And as such, going with this scenario, they would then be eligible to have $200,000 of the $250,000 loan forgiven, and this forgiveness won't create a taxable income to them. In addition, I'm sure as Christina will discuss in her section, the remaining balance of the loan could be deferred for 6 months, and I think it's up to a year. And I think we have one more question that we wanted to touch upon, and I think some people have questions on this. So if I have applied for or received an SBA Economic Injury Disaster Loan, an EIDL related to COVID-19 before the Paycheck Protection Loan Program became available, can I still apply for the PPP? And so the answer is yes. You can have both loans outstanding. If you've already gotten the EIDL loan or applied for one, you can still apply for a PPP loan. In addition, if you have received an EIDL loan prior to obtaining the PPL loan, you can actually roll that into or refinance that into the PPP loan. You can refinance the EIDL loan into the PPP loan, with the caveat being that the loans couldn't have been taken out for the same purpose. And again, the key takeaway here is that any remaining portion of the EIDL that you may have for purposes other than the expenses that are forgivable based on the PPP loan terms would remain as a loan. And in addition, if you took advantage of the emergency EIDL grant, which is up to $10,000, that amount would be subtracted from the amount that was forgiven under the PPP. And so that concludes my portion of the presentation. Thank you, everyone.
Thank you, David. Obviously, a lot of information there. We could probably spend 5 hours just going on that topic alone, but we're only working with this 1 hour time window. Keep in mind, everybody, as I mentioned before, I know a lot of people have questions. We have the availability to download those questions, and our team and task force is currently working on a frequently asked questions sheet that we'll be publishing on our website in the next few days. So your questions, while every business has their own nuance, we'll try to address what we think is going to impact, a lot of different clients, and trying to cover, frequently asked questions in a publication that will be put out on our website in the next couple of days. Before we transition to Christina, we have another polling question that will run now, the second polling question. So we'll give it a few seconds up there for 30 seconds or so for people to answer. Just not really a right or wrong answer to this one, just asking if you need help with the loan process or, you feel comfortable with it. All right, we'll wrap that up here in the next couple seconds. Seems pretty even, 50-50. All right, and last but certainly not least, Christina Ashby, the VP Wholesale Risk Officer from City National Bank, is going to give an overview and go a little bit more into detail about the Paycheck Protection Program from the bank's perspective. So, Christina, the floor is yours.
Okay, good afternoon. David gave a lot of really great information about the program, and now it's really more of how do we as the banks help you to get these loans. And so there's been a lot of misconception. A lot of people hear SBA loans, and so there was a lot of confusion between the EIDL loans and the PPP program. And so the EIDL loans are loans that are made directly through the SBA out of the Treasury. You apply online. So you might have seen applications already in place where you can go right online to the website or get the paper form and mail it in. So we constantly get questions at the bank of, well, my friend who owns a business already has the application and they filled it out and they were approved. And so that is a different program that is not eligible for the forgiveness. It is a $2.5 million loan that has very different terms. So to refocus on the PPP program, this is a 2-year loan that can go up to $10 million based on the multiplier that we previously discussed. And the interest rate on that is 0.5%. Yes, you heard me right. It is 0.5%. And so these loans are going to be made directly by the bank. So you do not have to go directly to the SBA to get these loans. And I'm sure many of you that may have applied for the EIDL loans know that there is a little bit of a bottleneck with a 3-week wait time on those just because of the sheer amount of volume that they're getting. But these loans will be made directly by the bank in partnership with the SBA. So that has not gone live yet. And we did yesterday get a very preliminary application form, SBA Form 2483, which is available on the Treasury website. And that is really just for guidance for the banks and to kind of get an idea of the questions that we should be asking in order for us to complete the application process. However, you might see that the lenders that you're working with might have different applications, perhaps digital, to streamline the process. But it'll be a lot of the same questions because it is our responsibility to determine eligibility and make these loans. So if you've ever heard of an SBA loan in the past, you'll know that you go and apply to the bank, and the bank, under its delegated authority, will then make the loan to you, and they're the ones that fund and manage the loan. These loans are guaranteed by the SBA, but they are handled in-house by the bank. So this is very similar, except that it's a very streamlined process. So a lot of people hear the words SBA and they want to run away because it's an onerous process. It's a lot of documentation. A lot of times there's a lot of restrictions that are very different from conventional lending. However, this program is very different. This is one that we will be able to streamline, and from what we're looking at within the bank internally, be able to, at the time of having a full application to closing, be able to fund these loans within about 48 hours, which is very different from the way that we look at SBA today. So I say all that because we are not actually live yet. The SBA has not given their guidance as far as the actual like SOP terms for this program. We have gotten guidance from the Treasury, which is what we've presented to you today. However, the procedural notices haven't come out. And so we are expected to go live on April 3rd. And that will be the day that you'll be eligible to apply for one of these loans if you are a small business or sole proprietor. Unfortunately, independent contractors and self-employed individuals will need to hold off until April 10th. Primarily, we believe it's because the SBA is still working on the guidance as to the parameters around that program and how it's going to define the loan forgiveness piece. So as part of the process, because we're doing these under delegated authority, it is the bank's responsibility to verify all of the information that's relative to this program. And we are asking borrowers to be prepared to provide their bylaws, their payroll expenses, which if we look on the slide, you can go a little bit further on the next slide. So we'll have, like, for W-2 employees, you'll have to provide us with all of your payroll information for all of your employees. I know that ADP is working with a lot of employers today to be able to run those reports to be prepared for this program. And you'll be required to provide information to us in regards to your P&L for the trailing 12 months, mortgage statements, utility bills, as well as the payroll verification information in order for us to determine eligibility. These loans are going to be non-recourse, which means that you don't need to personally guarantee the loans. That being said, we will not be pulling personal credit. However, if you don't use the loans for the intended purpose or use of proceeds, the SBA does have the ability to take recourse when the proceeds are not being used for its intended purpose. The credit elsewhere test is not applicable to these loans. If you've ever looked for an SBA loan before, the requirement is that you are not able to get a conventional loan elsewhere with another bank. That's not how it applies for the purpose of this program. There is no collateral requirement, so these loans are completely unsecured, and we will not be testing for that information. So it should be a very quick, streamlined process of just basic information to determine your loan amount that is related to your payroll. And then again, we would need information on your financials, most recent financials, mortgage statements, utility bills, and then we are going to require for all the borrowers to complete a borrower certification form that basically says that you're using this for the intended purpose of what it's designed for under the program. And that's all I really have. If there's any specific questions around what additionally the banks are going to be looking for, ultimately, the bank is really the one spearheading the process here, and we've been working very tirelessly to be able to roll out these programs to the borrowers. Again, we're going to be going live on April 3rd with the program, and we're still waiting on some additional guidance from the SBA. However, you can apply for these loans directly through your bank.
Thank you, Christina. So just a quick question and clarification. The applications we know were released yesterday for the program, but from what you're mentioning, just to clarify, that it's not something that you can actually submit it to the bank yet, correct?
So there are banks and other lenders, non-bank financing lenders that are accepting applications currently. It's nothing more than just a piece of paper at this point, because we, the banks, have to process these loans through the E-Train system in order to get an SBA loan number, and that has not actually gone live and won't be going live until Friday. So while you can submit an application and start submitting your financials to the bank, you will not be able to get the SBA loan number until Friday. And I also want to highlight that this is a process. You apply for the loan, you have your 8 weeks to use the loan. Eligible for the forgiveness, apply to the same banks that made the loan and say, hey, I'm interested in participating in the loan forgiveness program, and so I want to submit that to the SBA. And so the bank itself will be doing the review of the documents and the information and submitting it to the SBA for your loan forgiveness. And that application process will be open until 12/31 of 2020.
Okay. So I guess what we're gathering here is, although you can't technically get approved or anything for it, you have to start gathering all this data here and having it ready to go along with your filled out application.
Correct.
Perfect.
And so at the end of the
presentation,
there are...
Go ahead. Go ahead.
Yeah, sorry. At the end of the presentation, there is contact information for 3 of the lenders within City National Bank that are very well prepared to answer any of your questions and actually start the application process with you. We've been working very diligently on the clock with a lot of our clients to be able and if you have any additional questions in regards to SBA eligibility, my information is also at the end, and I'd be happy to answer any questions as to eligibility concerns.
For that, I think we're having with the I think we're losing David there. We're going to go ahead and open up the next poll so everybody can complete their CP And the question, small businesses and sole
Yeah. Quick thing that I think Christina may have alluded to. So while everybody's answering the polling question, I just want to chime in that if you do decide, and Christina may have mentioned this, if you do decide to roll your EIDL into the PPL, you would essentially be reducing the term down to 2 years. Correct, Christina?
That is correct. So while it has some benefit of a lower interest rate, number one, it would be reduced to 2 years. Number two, that portion of the loan would not be considered forgivable under the program.
And I think,
that's important for people to
understand. The correct answer there was April 3rd, 2020. Again, apologize for the technical difficulties here towards the end.